China's hegemony, not only in Asia, but in the world, is ending. A lot of factors like the COVID pandemic and the Chinese Communist Party's own hostile foreign policies have contributed to the mix of the decline of the Chinese empire. One nation, however, has emerged as a beneficiary of China's woes and an accelerator of China's problems, rising to glory in the wake of China's burning ashes. That nation is none other than the Asian country of Vietnam.
Vietnam is emerging as a low-cost alternative to China.
The opportunity in Vietnam is huge.
Since November 2022, we see a huge amount of foreign investors coming back to the market.
With a plentiful workforce, the government opened its doors to high-tech companies, looking to bring them from China, where a worker's average salary is 3 times that of Vietnam.
When you consider the rating which Vietnam is on, it's a very attractive market for the long term.
Vietnam, which is one of 12 nations in the pack, is positioned to hugely benefit economically. The agreement could also loosen Vietnamese ties with China.
The world is now abandoning China as companies like Nike, Adidas, and Samsung are choosing Vietnam over China. It legitimately seems like China's day in the sun is over, and Vietnam's glory days are just beginning. In today's video, we will be going over exactly why this is happening and how Vietnam is checkmating China. We will discuss Vietnam's rise to power and the factors that have given it an edge over China in recent years. Lastly, we will discuss China's role in all of this, and if truly the great dragon of the East is down for the count, or if the world's media is rushing to make an early verdict on a battle that still has life in it. So without taking much time, let's get into it. As we do that, please take a second to like this video and drop a comment on the next topic you'd like us to cover. By liking the video, you can help push the ever-hostile YouTube algorithm in our favor. These videos take time and effort to make, so your response as a community means a lot to us, something we're grateful for. Okay, now let's get to talking about Vietnam. We know some of you might be surprised to hear that Vietnam is well on its way to becoming a global economic giant, but to be fair, this was a long time coming. Vietnam has always been living in the shadows of other Asian nations like China and India, but that's not to say it hasn't been, if not more progressive with its economy. In the past 30 years alone, the nation has undergone a transformation, and poverty reduction has played a fundamental role in bringing the nation to where it is today. As reported by the World Bank, the poverty headcount in Vietnam fell from nearly 60% to 20.7% in the past 20 years. That is miraculous growth if nothing else. From within the shadows, it seems like Vietnam has quietly transitioned from being one of the poorest global economies to one of the fastest growing with room for even more growth. Let's trace this progress path now, shall we? Most people, especially here in the United States, are only familiar with Vietnam because of the Vietnam War that went on from 1954 to 1975. The war was a long, drawn-out conflict that pitted the communist government of North Vietnam and its allies in South Vietnam, known as the Viet Cong, against the government of South Vietnam and its principal ally, the United States. The war ended up being a proxy war between Russia and the US in what was almost an idealistic war, a battleground for the Cold War. Most Americans will remember it as a costly affair that showed the fighting spirit of the Vietnamese people, even against a superior power. Well, after the US military retreated from Vietnam in 1975, the country's economy experienced severe developmental issues, resulting from the inefficiencies of a centrally planned economy, residual war effects, and low productivity rates that made it import dependent. These issues stifled growth, making the Asian nation suffer economically on top of all the instability that came with decades of post-war fever. To add to that boiling mess of hot Cheetos, Vietnam's invasion of Cambodia in 1979 to remove the Khmer Rouge government complicated the economic woes the country was already suffering from by redirecting resources to the war effort. These are resources that the struggling nation could have used for its people, but no, they were being used to fund yet another war. As a result of this, Vietnam faced the wrath of the international community, which condemned such actions. In fact, the US went as far as to impose sanctions, a situation that only served to further collapse the Asian nation. All these economic deficiencies and global tensions resulted in Vietnam's economy being one of the poorest in Asia, with a GDP growth rate of 2.8% in 1985 and a 378% inflation rate in 1986. One could say that reaching this bottom barrel of poverty is what inspired change to come. This is because in 1986, the Vietnamese Communist Party, or VCP as we'll be referring to it, set out to transform its economy. We suppose they woke up one day and decided that enough was enough and that it was time for a change. The VCP then shifted the economy from a centrally planned model to one that utilized market forces to allocate resources. The reforms, popularly known as Dongmua, encouraged private industry, recognized private land rights, and abolished collective farming. The main thrust of the Dongmua was to promote a multi-sector economic system, emphasizing the state sector while encouraging the private sector. To achieve economic integration, the open door would be implemented gradually in order to stabilize the political and social situation. Dongmua, in its early stages, was focused mainly on the removal of self-imposed barriers to progress and the utilization of various market-oriented measures, including liberalization of the domestic market, encouragement of foreign district investment and the private sector, and reduction in subsidies to state-owned enterprises. These changes, along with Vietnam's military withdrawal from Cambodia in 1989, set the country on a course toward one of the quickest and most impressive periods of economic development in world history, an achievement whose successes we are discussing now. In 1986, when the VCP first implemented these reforms, Vietnam was one of the poorest countries in the region, with a poverty rate above 70%. That means that over 70% of the nation's citizens were living in abject poverty. That's 1 in every 10 people. That is quite the number. However, by 2020, this rate had declined to 5%, as in 0.5 people for every 10. That is quite an improvement. Also, as a result of the reforms, Vietnam went from a country faced with perpetual food shortages to, in 1989, for the first time, exporting 1.4 million tons of rice. It has since remained a rice exporter. In 2008, it exported 4.7 million tons, becoming the world's second largest rice exporter after Thailand. Indeed, Vietnam's exports were instrumental in stemming the threat of a severe international food crisis in early 2008. Vietnam hasn't looked back since, with it in 2022 being the 3rd top rice exporter in the world. It's very clear to see that the VCP's reforms have had such an impact on the nation. Looking at the numbers, you can see that in the 2010s alone, over 10 million people were rescued from the jaws of poverty by these VCP reforms. In less than a 30-year period as well, the country's GDP per capita also increased nearly tenfold, from under $300 in the 1980s to $2,800 in 2020. Let's be honest, if the world was a classroom, Vietnam would definitely be getting the prize for the most improved student. A lot of factors over the years have contributed to Vietnam becoming what it is today, and all this has led to the nation becoming one of the best investment places of the new age. The small nation has become a key part of the global supply chain, for textiles becoming an alternative, in some cases a better one to nations like China and India. The manufacturing capabilities of Vietnam have been so great that footwear and textiles made up 18% of its exports in 2018, while electronics and electrical equipment made up 40%. This number has only risen, getting higher and higher over the years. As this number has risen, so has Vietnam's relevancy so far as manufacturing is involved. This relevancy has been so much so that major companies like Adidas, Nike, and Samsung, among many others, now have a manufacturing presence there. As a result of this, it is no surprise that Vietnam's foreign direct investment has grown over 200 times since 1986, from $40,000 in 1986 to around $15.8 billion in 2018. Meanwhile, its exports increased by 19% from 2020 to 2021 and have only grown higher to date. Vietnam's growth in the region is now directly affecting and competing with China, the world's current biggest manufacturing hub. Vietnam has been growing at a steady pace and in silence, with its own economic growth eclipsing China in relation to its own economy. That means that even though China still outpaces Vietnam by far, Vietnam's growth rate has been higher than China's and higher than any Asian nation overall. Take a look at this table of growth projections in Asia. Vietnam leads the pack while China's own growth is slowing down. There almost seems to be a direct inverse correlation to the success of Vietnam and the misfortunes of China. It seems that as China slows down and loses out on growth, Vietnam is growing and developing more. Is there a direct relation? Well, we think yes and no. Let us explain. Firstly, the yes part. An undeniable fact of the matter is that part of Vietnam's growth, a huge part of it, is due to the great power competition between the United States and China.
The rising tensions between the world's 2 most powerful countries, the United States and China.
Game on here. A trade war between the United States and China is here. It's real. At the stroke of midnight, the U.S. hit China with tariffs on $34 billion worth of goods.
A battle between China and the U.S. over the self-governing island nation could result in devastating mutual losses.
So we don't have trade, we don't have anything near free trade with China. We've opened up our markets to the Chinese for 25 years. This is my point.
Tensions between China and the United States, as I mentioned, are running high. Their defense chiefs are in a war of words.
It's China's fault. And you know what? It's not Joe's fault that it came here either. It's China's fault.
You see, in the past couple of years, as the tension between the United States and China has grown, the Chinese Communist Party has taken a less business-friendly posture. American businesses operating within China have found themselves on the short end of the stick as they have faced tons of retaliatory measures from the Chinese government, almost as a punishment for the US government hostilities. Let us give you a simple example. After Micron, an American tech company, rebuffed a 2015 takeover attempt by a Chinese state-owned company, it watched with disbelief as its innovations were stolen and copied by a Chinese competitor, and its business was blocked from China. It is China's treatment of American companies like Micron that contributed to former US President Donald Trump's decision to unleash a punishing trade war with the world's second-largest economy, a fight he said would halt Beijing's use of unfair practices to undermine the United States. Another example is the Marriott Hotel incident, an incident that shows that China has and will retaliate against companies it is displeased with. After Marriott had referred to Taiwan as a separate country on its website, the Beijing government shut down its online reservation site in China for a week. The company then had to issue an apology in an attempt to rectify the matter. The chief executive, Arne Sorensen, wrote in a statement on the company's website saying, "Marriott International respects and supports the sovereignty and territorial integrity of China. We don't support anyone who subverts the sovereignty and territorial integrity of China, and we do not intend in any way to encourage or incite any such people or groups. We recognize the severity of the situation and sincerely apologize." These are all examples of how the Chinese government could easily and has been making life difficult for American companies. Things like slowing down the permitting process for new stores or imposing stiff fines for minor infractions have not been known to be foreign. Add to the mixture the harsh zero-COVID policies that China has been putting into place, and what we have left is nothing short of a horrible business environment for most companies, particularly US ones. This has left companies feeling limited, insecure, and seeking alternative supply chains in a bid to reduce risk if and when any disruptions occur. Perhaps it is no wonder then that in 2021 alone, more than 11,000 foreign firms canceled their company registration in China. That's a big number. Others like Apple, Samsung, and Hasbro, which have had significant and long-standing manufacturing operations in China, have decided to reduce their operations in the country. And you know who they turn to in all of this? Sweet, reliable Vietnam. All this makes us think that Vietnam is the sweet best friend who capitalizes when a toxic couple breaks up and then ends up getting the girl. You know, your typical rom-com plot. In this case, Vietnam got the US, or rather a good portion of the business that the US was giving China. Vietnam has really benefited as major companies have moved their manufacturing there to take advantage of the low costs, developed infrastructure, supportive business environment, and success in mitigating the economic effects of COVID-19. For instance, Foxconn, the prominent electronic manufacturer that contracts with all major technology companies, including the behemoth Apple, announced it would invest $300 million in a new factory in northern Vietnam. Another giant, Google, has announced recently that it plans to ship as much as half of the production of its Pixel phones to Vietnam, while Microsoft has utilized Vietnam for some of its Xbox production. A few years ago, these corporations would have exclusively produced these items in China, but now, Vietnam is getting a big piece of the cake. The fact that these companies are also investing in factories and the like in Vietnam means that this is not a fad, but a long-term commitment that will only serve to benefit Vietnam more as the years progress. The Asian nation's growth, however, had not just been due to the US-China trade deficiencies. There have been other pull factors that have made Vietnam an attractive choice. Let's get into those, shall we?
Smartphones and other gadgets are manufactured in China these days. But what about Vietnam?
Vietnam's economy jumped by 8% this year.
The PVHs, even the Adidases and the Columbia Sportswears, they've all sourced product out of Vietnam, and they have been doing that for years.
It's emerging as an alternative to China with its tax incentives and cheaper workforce.
The U.S. is importing 40% more from Vietnam than this time last year, while imports from China down 13%.
Okay, we've warmed you up on the successes of Vietnam. So we know you're asking yourself now, saying, how did this growth miracle happen? Other than the opportunistic approach it took with the US-China trade war, Vietnam has had other factors accelerate its growth. Analysts from the World Bank think that the nation's entire growth can be condensed together into three main factors we're about to dive into right now. The first of these factors is the simple fact that due to the VCP's policies, Vietnam has thoroughly embraced trade liberalization with gusto, with 95% of Vietnamese people agreeing to say that trade is good in a 2014 Pew Research survey. It makes sense that the people think so, because trade and globalization have been incredibly good for the nation. Vietnam's exceptionally globalized economy is a result of its focus on exports for economic growth. Over the past 20 years, Vietnam has signed numerous free trade agreements in order to become a contender on the global stage. In 1995, Vietnam joined the ASEAN Free Trade Area. In 2000, it signed a free trade agreement with the US, and in 2007, it joined the World Trade Organization. Since then, further ASEAN agreements followed with China, India, Japan, and Korea, and recently the amended Trans-Pacific Partnership went into effect. These agreements were made with the hope of gradually lowering the tariffs imposed on both imports and exports to and from Vietnam, thereby making it more trade-friendly, and making the trading itself cheaper to do. Suffice it to say, this has worked out quite well. Like China before it, Vietnam has opened up its cheap labor market to foreign investors and become a hub for low-cost manufacturing. The country is now a major exporter of electronics and apparel, with the United States and China as the main destinations for its goods. In order to make those goods, Vietnam is a major importer of machine parts and natural resources from South Korea and China. All of this has seen Vietnam's GDP per person grow from about $1,500 in 1990 to about $6,500 today. Quite the significant rise if we do say so ourselves. Also, unlike in some fast-growing economies, its new prosperity has been shared in the nation. The proportion of people in extreme poverty fell from above 70% in the early 1990s to around 10% in 2016. The World Bank credited the jobs created by Vietnam's export sector for this remarkable poverty reduction in a recent report. Perhaps most importantly, the economic growth was fairly inclusive. According to the World Economic Forum's Inclusive Development Index, Vietnam is part of a group of economies that have done particularly well at making their growth processes more inclusive and sustainable. Women, too, fared better. Their employment rate is within 10% of that of men, notes the World Bank, and women-led households are less likely than those by men to be poor, although inequalities remain. That's the kind of growth that's admirable. Oddly enough, even as Vietnam is checkmating China by taking business from them, data from the General Department of Customs shows that in 2022, China was Vietnam's largest trading partner with a total two-way trade turnover of $175.57 billion. This is a lot of trade being had there. This was followed by the US, who had $123.86 billion, the Republic of Korea, who had $86.38 billion, and Japan, who had $47.61 billion, all worth of trade. Trade between Vietnam and the US has been particularly good, with Vietnam being one of the top 10 largest goods trading partners of the United States. The total two-way trade value of goods in 2020 with the US was $89.5 billion. Goods exports to Vietnam from the US totaled $9.9 billion, while goods imports from Vietnam totaled $79.6 billion. This figure has only risen with time, as in 2021, Vietnam exported $99.3 billion to the United States. The main products exported from Vietnam to the United States were broadcasting equipment $17.4 billion, other furniture $6.23 billion, and seats worth $4.53 billion, among other things. Don't find these objects surprising. It's simply what the US mostly imports from Vietnam. In fact, in the past month, the top 3 US imports from Vietnam, also by value, were cell phones, related equipment, computers, and furniture parts. We had to mention that for those of you who might have been surprised that the US imports furniture and seats. In 2022, the total two-way trade value between the nations was, as we mentioned a second ago, $123.86 billion. We emphasize this to show you just how much these trade figures keep going up, as trade between the two nations keeps improving year after year. So yes, we think it is quite safe to say that trade and globalization has been an important tool that Vietnam has managed to use in its favor. The second factor that Vietnam has going for it is that through its own domestic policies and extensive reforms, the nation has managed to put in place business-friendly regulations, all while lowering the cost of doing business in the nation. While trying to make foreign-friendly policy, the government's drive towards an open economy also included domestic reforms that targeted matters of governance from the inside. In 1986, the country created its first law on foreign investment, enabling foreign companies to enter Vietnam. Since then, law firm Baker & McKenzie said in a 2016 report, the law has been revised a number of times, mainly to adopt a more pro-investor approach while aiming to reduce administrative bureaucracy and better facilitate foreign investment into Vietnam. This has worked, seeing as that the foreign direct investment in Vietnam averaged $7.29 billion from 1991 until 2023, reaching an all-time high of $27.72 billion in December of 2022. These were astonishing figures, and of course, they did not go unnoticed in international rankings. In the World Economic Forum's Global Competitiveness Report, Vietnam rose from 77th place in 2006 to 55th in 2017. In the World Bank's Ease of Doing Business rankings, meanwhile, Vietnam rose from 104th place in 2007 to 68th place in 2017. Last year, the bank said, Vietnam made progress on everything from enforcing contracts, increasing access to credit and electricity, paying taxes, and trading across borders. That's quite an achievement to make, and that is all thanks to Vietnam's own domestic reforms. Finally, the last factor that has contributed to the nation being where it is today is the fact that Vietnam has invested heavily in human and physical capital, predominantly through public investments. The Asian nation has truly invested a lot in its human capital and infrastructure. Facing a rapidly growing population, one that stands at just under 99 million today, half of whom are under 35 and up from 60 million in 1986, Vietnam made large public investments in primary education. This was necessary as a growing population also means a growing need for jobs. In addition to this, Vietnam also invested heavily in infrastructure, ensuring cheap mass access to the internet. This might sound minor, but with the Fourth Industrial Revolution knocking on Southeast Asia's door, having a sound IT infrastructure in place is essential preparation. At the end of the day, looking at Vietnam, one can see that those investments have paid off. Armed with the necessary infrastructure and market-friendly policies in place, Vietnam became a hub for foreign investment and manufacturing in Southeast Asia. Japanese and Korean electronics companies like Samsung, LG, Olympus, Pioneer, and countless European and American apparel makers have set up shop in the country, only serving to increase the nation's economic benefit. In fact, due to the infrastructure and labor investments in the nation, Vietnam is the fourth largest textile exporter in the world. That's quite the achievement for such a small nation. The amount of their exports is estimated to be over $38 billion. Specialization, modernization, and the manufacture of high-quality products are their primary goals to compete in this competitive market, and it definitely is working out for them. The nation's textile industry is made up of the downstream sector, fiber production, and upstream garment manufacturing. Growing garment exports to the United States, Japan, the European Union, and South Korea are a significant component fueling the expansion of Vietnam's textile sector as it keeps growing. It will be no surprise to see Vietnam directly rivaling China in the textiles industry in the years to come, as the company is on what can only be described as an unbelievable growth spurt. These three factors have collectively led Vietnam's GDP growth to increase, with it being at least 5% per year, and just last year, it peaked at a whopping 8%. This is in stark comparison to China, which grew from just 2.99%, its lowest since 1990. Just looking at this graph of Vietnam's GDP growth shows a tale of nothing but progress and increase. With such rapid economic growth over the years, the country has grown from one of the poorest countries in the world to a comfortably middle-income one. So, all this said, is there anything that can stop Vietnam from checkmating China? Despite all the high praise that we carry for Vietnam, the nation still faces severe hurdles to future growth. Perhaps the most important and the most limiting factor to the nation's ability to properly checkmate China is the country's population size. Quite frankly, it will never amount to more than a fraction of China's. You see, Vietnam is slightly less populous than China's southern Guangdong province, the birthplace of Chinese special economic zones in 1979, and still a key component in its manufacturing. Foxconn even had its flagship campus in Guangdong, while Chinese tech giants Huawei and ZTE are headquartered there. These companies are centralized there mainly because of the province's easy access to Hong Kong and coastal ports and access to the Chinese labor pool. Vietnam, on the other hand, has none of the benefits that come with being a province of a vast, economically diversified nation with the world's largest workforce. That's where they start to lag behind. According to a Beijing national census conducted in 2010, around one-third of Guangdong's population of 104 million were migrants from elsewhere in China. While Vietnam's rural population of around 65% certainly leaves room for urban migration to bolster manufacturing, The country lacks China's hundreds of millions of people ready to travel to fill positions as they arise. The factories in the Pearl River Delta churning out iPhones and Nike sneakers can rely on a steady stream of migrants from across China to man the assembly lines, while Vietnam has only itself to turn to. With a small population, what this means is that as the growth intensifies, Vietnam might not be able to keep up with demand based on the simple fact that it will run out of labor. This puts a cap on the level of growth they can experience. In addition to this, in comparison to China, Vietnam's workforce is relatively low-skilled, and its energy supply is having a hard time keeping up with demand. And although the country has made significant advances in infrastructure development, it still ranks 47th out of 160 countries in this regard. That's yet another setback to Vietnam's plan to checkmate China. We know that some of you are asking yourself, other than labor shortfalls, can anything stop Vietnam's ascent to the top of the Asian food chain? Well, just like with most things, yes and no. With the appetite for globalization on the wane in many parts of the country, Vietnam looks particularly vulnerable, and with good reason. Vietnam's exports are worth 99.2% of its GDP. Yes, 99.2%. Just to further clarify that figure, what we're saying is that Vietnam's whole economy is basically based on foreign investment and trade. If anything at all were to hinder supply chain movements, or if the foreign policy of its top trading partners shifted against it, Vietnam would be stuck in some very hot and unpleasant soup. This is a real possibility given how geopolitics and the political economic landscape are always shifting. However, for now, Vietnam looks to profit from rather than be hurt by increasing global trade tensions that constantly rock our fragile world. Despite Vietnam making ground on China's economic territory, the truth of the matter is, China's advanced supply chain and supplier network, driven by the government's long-term national policies, make it a manufacturing giant. At present, no one country, including Vietnam itself, can fully replace China's manufacturing capacity. Let's take a moment to assume that in some way, Vietnam could bridge this gap and replace the Dragon of the East. Even if this were possible, it most certainly would not happen overnight. This is a process that will take time as businesses figure out which parts to relocate and how to navigate those waters. It will likely be messy to begin with, but processes will get easier over time if they were to happen at all. So you see, it's a yes and no situation. Looking inward, Vietnam's government has been pushing to move from being a low-tech manufacturer to high-tech manufacturing. Recent investments from Intel, Samsung, and UAC show that there is immense potential in the country. And while it is safe to say that Vietnam can't absorb all of China's manufacturing, it is well positioned to take on more production, along with other countries in the region, and to play an important role in global value chains. We believe the best way to tell the tale of this Asian country is in this one statement: Vietnam is growing at its own pace and its own way. Whether it will truly eclipse China or not is something that time will tell.